What is up, you guys? Welcome back to my channel. My name is Nikki, and in today's video I am going over the 3 best Dividend King stocks still worth buying in 2020 and beyond. You know, that dividend investing, getting that passive income, all that good shit we trying to get. So let's just get into the video. First, if you are new here, what is up? My name is Nikki. You know what I mean? The absolute world to me. If you would consider subscribing by hitting the MB in the bottom corner or the OG subscribe button down there underneath the video below, join the crew, join the journey. On this channel, I post a minimum of 2 videos a week all about stocks, money, finance, investing, side hustles. I like to make money, entertain, and educate along the way, and I'm just really into investing for something bigger than ourselves. So if you are into that, or if you like hanging out with me half as much as I love hanging out with each and every single one of you, please consider subscribing. Alright, y'all, so in this video I'm going over the 3 best Dividend King stocks that you should still be buying in 2020. So first things first, what the heck is a Dividend King? So a Dividend King is a company, a stock that has been consecutively growing and paying their dividend for a minimum of 50 years. And as a dividend investor, we obviously love that kind of consistency. And the second thing you might ask, well, if they're that consistent and that safe, wouldn't any Dividend King be worth adding to my portfolio in 2020 and holding it? And my answer to that is hell nah. And here is why. Because if 2020 and this, you know, day and age has taught us literally anything, I think it's safe to say that life as we know it can change in basically the blink of an eye. I mean, the way we literally do everything, our economy, the way we live, how we eat, how we shop has changed. Companies that were solid 50 years ago may not be able to adjust and thrive and survive in the upcoming day and age. So that's something that, like, you should really pay attention to and really consider when you're investing in companies, even though they have insanely secure dividends for the last 50 or plus years. Just because that dividend is solid, and that is important, but it's also very important to know that these companies can survive and thrive and live through basically anything, or at least the direction that I feel like our economy and our life and our style of living is really going. Also, if the dividend yield and the dividend payment is the only thing that matters to you and capital gains and growth in a company means almost nothing and you just want that dividend, 1, I would reevaluate that strategy, and 2, I personally am super hot for companies that not only pay me a great dividend but continue to grow, and that last 5-year chart minimum is looking more like this than like this. Okay, you know what I mean? Like, we have to have some growth. You can literally have a company that pays a 3% dividend for the last 100 years, but that 5-year chart look like this. I'd probably reevaluate, because I'd rather put my money into a company that pays a dividend of 1% that looks like this, just because you gonna make more. I mean, I don't know. Am I stupid for that? I think you just have to figure out what you want to do. For me, it's dividend and growth. So with all of that being said, let's go ahead, let's saddle up, and let's just get straight into the stock talk. So the 3 stocks that I'm going to tell you about obviously have great financials, cash flow, balance sheets. Their dividends are clearly safe. Otherwise, they would not be Dividend Kings. And you guys already know my philosophy about that. If that doesn't match up and companies don't have solid financials, don't really look at them, okay? I mean, any stock that I talk about, financials are decent enough for me to look further into it. And by further into it, I mean really looking at the company and the business, as a model of what they're doing. If I can stand behind them and support them with what they believe, their products, how they act, the management, all that good stuff. Because when you buy a stock, you're buying a part of that company. So if you don't understand that company, you probably shouldn't buy it. All right, y'all, so the first stock I'm gonna talk about is Lowe's. Now, Lowe's is currently almost at $154, and I went into in-depth kind of why I think Lowe's is a little bit overpriced at the current valuation and what it's trading for. So I will go ahead and link that down in the description box below. But just some basics here, we can see what it's trading at, and it's going to be changing because the market is open right now. If we scroll down here to some stats, you can see that they pay a 1.44 dividend. Now, PE ratio a little elevated, so that's one reason why I think it's a little overpriced currently. And then you can kind of just see analyst ratings. I'll show you a little bit of the gold. It's got 2 stars, meaning it's a little bit overpriced. They think fair value is around 111. I actually kind of disagree with that. I think around the 130, 140 mark is a solid buy-in point for them. So I wouldn't say Lowe's currently right now at this price is a good buy-in, but long term, I think it's one you're gonna wanna look at. All right, so there are 3 big main reasons why I feel like Lowe's is a safe and great investment for 2020 and longer. So Lowe's has 54 years of consecutive payout rate with a dividend growth rate of 17.6% per year in the last 3 decades. So with growth numbers like that, their payments and the historical data to back it up is a huge weight off of a lot of investors' shoulders. It's very safe, very sustainable. So numbers wise, that's a big factor. The second reason why I absolutely love Lowe's, their service market. So essentially, let's say there's a pie, okay? It's like a pie graph. Y'all remember that from elementary school or whatever have you remember the pie graphs. 70% of it is made up by retail and individual consumers like homeowners or, you know, just families, things like that. The retail side, the consumer individual aspect of the business. But there's a 30% chunk out of that pie that is professional use and professional services. So this hypes me up because that 30% of professional is a great growth section for Lowe's. The more professional people, the more companies that they work with, network with, market with, and market to that use their services and use their products to go do vast, big projects on a professional level is going to increase growth within Lowe's and the business. So that 30% chunk is a big key factor for me, which is why it's in my top 3. 70% of retail is also very important. I'm gonna tell you why. Because for me, that represents consistency and like hygienic business. I don't even know if that's a damn word, but I'm gonna explain what the heck I'm thinking. Hygienic business, I don't even know. But I think you get it, like hygiene, okay? Like you and I, hopefully, I mean, not all the time, but hopefully we showering every day, every other day, but we keep a good hygiene, right? Like we have a schedule. We brush our teeth, we take showers, we do the stuff that keeps us clean and fun and fresh and just with it. So that's 70% of the pie for Lowe's is retail and individual consumer, and that is their hygiene. That's their consistent business. It's their sturdy, reliable business that keeps Lowe's right where it needs to be. It keeps it afloat, it keeps it consistent. Now, I will venture, and this is kind of why I think the stock price is overpriced, is because of what's going on with COVID, how everybody's staying at home. They realize this, and this needs to be done in their house. So they're taking on more DIY home improvement type projects, which is driving sales in Lowe's, which is they're driving the stock price up. And even though I see it more as a consistent, hygienic part of the pie for Lowe's, if we do adapt to a new stay-at-home economy where everyone, not everyone, but majority of companies and people do have that option to work from home, then they may continue to take on more projects at home because they'll see more being at home. And if I say at home one more time, I don't know. Just being at home is causing people to see more around the house that they want to do and take on and improve. And so Lowe's is really reaping the benefits of that. So the 70% with what we're doing right now, plus that 30% for them, I don't know, y'all. Obviously, with a business model, you have senior executives, you have chief officers that are running the damn show. And that is also a very important thing to look at. I feel like when you're really going to make a long-term investment, it's very important to know who the captain of the damn ship is. And at a company like Lowe's, there is a big senior management branch, a big senior management kind of executive squad. But the one that I want to focus on the most here that really piqued my interest and made me think long-term is this lady right here, Marissa Thalberg. Look at her. I mean, she's just full of energy. She loves the smile, the glasses, the bow. She's just really rocking that Lowe's vest, looking I almost said tight, but that's kind of weird. Anyway, you get it. She is the executive vice president and chief brand and marketing officer. And you can read her bio if you want, but I'm gonna go ahead and just highlight a few reasons why she really gets me excited for Lowe's and really makes me think about the future and holding it now in 2020 and beyond long term. Being that she is the chief brand and marketing officer, marketing, promoting Lowe's, she's a very key player in the growth and longevity, I feel like, of this company. Now I'm gonna tell you guys 3 quick reasons why I really rally behind her. So the first one is that she joined Lowe's and took her position on that executive board in 2020. So she had to pivot and adjust ASAP. Like, she had no time to compare some old bougie Lowe's marketing with some new, like, she came in hot off the press with this whole thing going on that she had to adjust very quickly. And with the way things are going for Lowe's, that just kind of makes me think like, well, she's doing something right because it's taking off a little bit. And y'all already know I have some notes here and I don't want to mess this part up, so I am going to read off my notes specifically for this next part. But this next part really got me excited, y'all. And that's because prior to Lowe's, she was the global chief brand officer for Taco Bell. And at her time at Taco Bell, she achieved record sales growth. It was the highest passion index with fans in any brand of the restaurant industry, and it was the second fastest growing brand in the nation, only behind Netflix. It's crazy to think I had no idea that this lady even existed, to be honest with you, but like, if you think of Taco Bell and you think of their brand, their marketing, their advertisement, that stuff sticks to you. So the fact that she was the mastermind behind that just makes me really excited to see what she could do for Lowe's in the long term. And the third thing is that she was named one of the world's 50 most influential CMOs by Forbes in 2017, 2018, and 2019, and named one of the top 25 most innovative CMOs by Business Insider. That's what I like in a marketing officer. We like influential and we like innovative. Innovative is creativity, something that sticks with a brand to the marketing, and influential meaning she got game. She's recognized, she's sturdy, she's strong, and she's ready to go. She got the street cred, if you know what I mean. I think Lowe's is an exceptional add to your portfolio for 2020 and beyond. What do y'all think? Do you agree with Lowe's? Do you disagree? Please let me know down below, and let's move on to the next one. All right, y'all, so the next one is a solid stock, probably for obvious reasons once I tell you what it is, and that is going to be AWR, American States Water. They're currently down just a little bit today, but if we come down here, they have a dividend of 1.53%. The PE is pretty elevated. You can see their earnings here, and there's not honestly a lot going on with American States Water, so let me just give you a few reasons why I think they'd be a good addition. All right, so they are one of the best, if not the top, and the top dog, the best of the dividend kings, because they have been consecutively growing and paying their dividends since 1931 in over 65 years of increased consecutive payments. And just super recently on July 30th, they announced that they were raising their dividend 9.8% from 30.5 cents to 33.5 cents per share. So that is obviously a very good sign that they, in the current times, could indeed raise it that 9.8% and consecutively continue to grow their dividend. Now, I do like them for three reasons besides the dividend, but in all honesty, I do have to say that this one is just a really good solid dividend play, being number one of the dividend kings with the recent addition and growth of the dividend. This is a heavy hitter if you are really focused on the dividend, but I will give you some reasons why the company I feel like can survive in 2020 and beyond. And that first main reason is the fact that it is water. I mean, we need that to live, to survive. Water is a non-freaking negotiable. So they're serving over 1 million people in 9 different states. And I just personally feel like water is never dated. Water will never go out of style, and hopefully it won't ever not exist, because then we'd all be dead. Second reason is the fact that they basically have 3 services that they offer, 3 brands. They're like a parent company to, is it Golden State Water? Not fully aware, but there are 3 things that they provide. So they have the American States Water, which is water. They have American States Utility, and they have Bear Valley Electric. So you got utilities, you got electric, and you got water. You got the basic utilities and fundamentals of life, of running a home, of keeping a family together, of keeping life sustainable. And those I don't feel like will really go out of style, at least in my lifetime. And what that also does is create a bit of a moat for the company. Y'all know I like fat moats. Go ahead and just comment down below fat moat. Wide moat is what I normally say, but she fat today. PHAT moat down below. Let me know, and I will absolutely love if this comment section just blown up with fat moat. That'd be great. And the third and kind of biggest reason why I put them on this list, and I'm gonna read it off here so I don't mess it up, but they provide operations, maintenance, and construction management services for water distribution and wastewater collection and treatment facilities at 11 military bases that are under 50-year contracts with the government. For me, 50-year contracts, 11 bases is guaranteed business. And when you do anything with the American government does not want the American government to fail, let alone its military branches and all of that good stuff. That is a big kind of safe grab for me. Anytime that you can put the American government in a contract and provide them services that they need for military men, I think is a good bet. Let's go ahead and get into the third and final stock. Obviously, I think y'all already know what's about to come out my mouth, and I'm pretty sure you would expect nothing less, and that is going to be J&J, Johnson & Johnson. They're currently at 148. Y'all already know the deal with J&J. I mean, 2.60 dividend. They're amazing, and you can see the ratings here I'm buying. You can see the gold report, the fair value estimates, pretty similar earnings, all that good stuff. And I know I've talked about J&J an unreal amount in past prior videos, so I'm not gonna overkill it here, but if you want to hear more about J&J, go ahead and go down in the description box below. I will link a few videos I talk about J&J a little bit more in depth, so I'm not going to just kill you with J&J fangirl shit right now, so just bear with me. Hold on, let's just get through the last few reasons why I think J&J needs to be in your portfolio. 1, 57 years of consecutive growing dividend payments out to the shareholders. I mean, hello. but that's expected as a dividend king. So the next reason, the product line of J&J, it's so damn diversified. I view J&J as its own healthcare ETF in and of itself, even though I know it's not. I feel like it is. There are basically 3 categories of business that J&J does that makes up their overall sales for the company. The first one is pharmaceutical, making up about 46% of their overall sales. The second one is medical devices, making up about 35% of their total sales, and then consumer and discretionary, making up almost around 20% of their total revenue and sales. And also the fact that they are international and they are running in a ton of international markets. And to be honest, healthcare obviously is very important currently, but just overall healthcare, science, health, medicine, making lives of individuals better through healthcare is very important for us as Americans and just human beings in general. So that's another reason why I absolutely love J&J. I don't think healthcare is going to go out of style. And I'm gonna not dive in, but I'm gonna mention something real kind of eye-opening here, is the fact that they have over 20 products that they produce in-house. And these brands are so big and so globally recognized that they make over $1 billion in annual sales by their own damn brand that they're doing in-house. So that means brands like Tylenol, Motrin, Benadryl, Band-Aid, Listerine, Neutrogena, and way more. Which means they're off patent nature, which means that it's low cost to produce these brands and produce these products. And there's extremely low competition because nobody else can say that they're Band-Aid or Tylenol. So what they sell them for is making them a ton more money than it would be if they outsourced it. So they're just a freaking behemoth. The fact that they can do that and just get such great returns on their sales and their revenue is just like, they're not slowing down, at least in my damn lifetime. I don't think so. And just the fact that J&J's consumer products, which is like one part of their pie, is outperforming 3 to 4% of the addressable market. Like, it's just like they're just doing the damn thing. I don't need to talk about it no more. Y'all already know. So y'all, I don't know, but it was actually very fun and kind of eye-opening to really look at the list of dividend kings and really kind of analyze each and every one. I think there's 29 or 30 on there, so there's not a lot, but it's very important because I feel like a lot of people think, oh, dividend king gonna be solid no matter what. But you have to remember that this economy and the way we live is always changing. And just because they've had the last 50 years of really dope shit going on does not mean the next 50 years is gonna be as good. You still have to be smart and do your due diligence. There are companies on the dividend king list that I would never invest into with my own reasons because I don't think they're gonna make it. And if you want to hear my input on that, let me know down below in the comments if you want to see that kind of video. And also let me know down below if you agree or disagree. Smash the damn thumbs up button for your girl. You already know how much it helps me, and I love y'all for that. And if you are this far and you are not subscribed, please do me a favor, do you a favor, do us a favor. Join the crew, join the journey, hit that subscribe button. And if you hear my voice right now, you are the real MVP. You're gonna get some kisses. Come here, you know I love you. And as always, you guys, enjoy the journey, whatever your journey is. And always remember to do what sets your hearts on fire. And I will catch you all in my next video. Bye, guys.